the 2020 Marketing Seminar, which is a program of the North Dakota Grain Growers Association and the Minnesota Association of Wheat Growers. This program is possible through the support of our members. Please consider becoming a member of your state wheat organization. Membership details can be found on the websites, ndgga.com and mnwheat.org. We'd also like to thank our sponsors for today's program, A-Country Farm Credit Services and the Northern Crops Institute. Our final presentation is Dr. Frayne Olson. Dr. Olson is a crops economist, marketing specialist in the Department of Agribusiness and Applied Economics at North Dakota State University. Dr. Olson conducts educational programs and research in crop marketing and market analysis, crop contracting, and risk management. Dr. Olson received his PhD in agricultural economics from the University of Missouri and his MS and BS in agricultural economics from North Dakota State University. Welcome, Dr. Olson.
All right, well, good evening, everybody. It's now a little past 6, so hopefully I won't drag this out and you guys can have some supper here pretty soon. I'm going to take a little bit higher level view of what's happening in the market and actually provide a little bit of global perspective as well. Brett was really talking nuts and bolts of marketing. What do you do on your farm? What are some of the strategies you can put in place? I'm going to try and give a little higher level and provide some context for some of the things that the current market analysts and traders are talking about, some things you may have heard in the news recently. Again, trying to put those in context to say, well, as we move forward in time, what do we really need to pay attention to? One of the challenges we have in today's world is that there's information overload, and it's really hard to kind of filter out and say, well, what are those nuggets of information that I really need to focus on? What are those things that will really have an underlying influence in market prices versus just kind of the buzz of the day or kind of the market jargon of the day. So title of my presentation, COVID, China, and Confusion. And I think there's a lot of all of those. There's a huge discussion yet about COVID-19 and the impacts, not only on the US economy, but globally. We're going to talk a bit about China and some of the buying behavior that China's recently had. And obviously the confusion part is all over the place. I don't want to go through a lot of the details of supply demand tables. That's not my point now tonight, but I do want to kind of refresh everybody's memories. There's really right now two underlying things that the market's focusing on short term. One of them is yield and yield expectations. And of course, the other is focusing on Chinese buying and what is the outlook as we move forward. So again, I don't want to go through all of the gory details, and I'm not intending to. I do want to talk a little bit about what USDA came out with on last Friday in their WASDE report. We have a huge debate going on right now on what the national average yield is. The storm in the middle of Iowa, the Derecho storm, what are the impacts primarily for corn, but also for soybeans. The interesting thing is this 178.5, we're basically back to trendline yield again. The expectations going into earlier as we got into the August report was that we're going to have this bigger crop. Obviously, right after that, we had the storm go through Iowa. We've had some very unusual weather in some of the key producing regions. Right now, when you look at what the market, that most traders and analysts were expecting USDA to put out is right smack dab in what the number we got. So again, just to remind everybody, the trend line yield, the dotted line on the far right-hand side represents the current USDA forecast for 2020 yields. So we are literally right back on the trend line yield. So moral of the story, the trend line yield being, we're looking at an average yield this year nationwide. And we need to remind ourselves of that. So even if we take a little bit of the top end off the corn nationally, we're still going to have a lot of corn around this year, even if we nibble on the edges of harvested acreage. And I agree with Brett that I do think some of that harvested acreage number will start to slip a little bit more as we get more information about the impacts of the storm. Okay, but to be really blunt and honest, in the big picture of supply and demand, I think this is going to be relatively small. Okay, it does make a difference because our bottom line, small changes here and there, just like in the financial area, small changes here and there, and all of a sudden the bottom line starts to shift and change. I also want to just remind everybody, and USDA gets beat up a lot, and they're an easy target to kind of pick on. But the process that USDA uses to forecast yields, especially now later on in the season, in the September, October, and obviously the November harvest numbers, the yield numbers. In September and October, and in particular this September report, there's actually 3 sources that USDA uses to come up with that 178.5. They use farmer level surveys, which is really still the primary source of data. Then they cross-check it with satellite imagery. Okay, and this is actually in the USDA, the chief economist's briefing. So again, that's now being published. So if you're interested in finding out where to get that, I can certainly direct you to it. But this is really the yield modeling map that they have. So they're using satellite imagery, overlaid with some of the rainfall data, the weather information, and they're trying to actually forecast yield. And the darker the yield, the darker the color, the higher the yield. And this just gives you a visual picture of where do we see the highest yields based on this USDA yield model. So they're using farmer surveys, they're using some satellite imagery as a cross-check, and they're also in the September and October reports using enumerators. They're actually having people go out to randomly selected fields and doing yield counts. And again, based on that information, they're compiling and saying, with these 3 sources, what do we think the national average yield is, as well as what's the yield by state. So by the time we get into September and October, unless it's very, very unusual weather conditions, in my view, my opinion, USDA does a pretty good job of honing in on what that final yield is going to be. Obviously, there still can be some changes and shifts, but I just it's at this stage of the game, I would not be betting against the USDA numbers. Let's shift to use. I'm going to spend a lot of my discussion right now talking about the demand side, because as we move past harvest, as we move into the rest of the marketing year, we're really going to be following this demand picture very, very closely. Just as a quick reminder for everybody historically to put this in context, the blue line on top is feed and residuals. So this is corn specifically. So how much goes into livestock sector, how much goes into spoilage and wastage? That's the blue line. The red line is ethanol. I'm going to talk about ethanol in a little bit more detail in a moment. The black line is exports. The green line on the bottom is kind of everything else. Those little dots in the end, again, represent the current USDA forecast. So again, given today's forecast, let's put that in perspective or into historical context. Obviously, because of some of the challenges we've had in the international market, our export pace has been falling the last couple of years. USDA is expecting a rebound, and a lot of that is because of China. The other thing is ethanol took a hit because of COVID-19. I'll show you some graphics in a minute. I know Howard gave an overview of that as well, but I want to show you a very similar graph. So let's talk specifically about ethanol. Again, this is as of, I updated the graphic that Howard showed. This is as of last week. We'll tomorrow now get some updated information on ethanol production numbers. You can see that very, very dramatic drop because of the basically shutdowns. Part of it was, again, because of COVID-19. Part of it was because the Russians and the Saudis kept pumping oil when they shouldn't have been pumping oil. The point I want to make with this slide is look at where we rebounded to. The current levels are this is kind of the at least short term considered to be the new normal for ethanol production. And most of the industry analysts, at least those that I have been looking for and kind of following and reading, are saying that they really don't expect ethanol production and more importantly gasoline demand to really recover to levels that we would be considered normal or historically normal, probably until 2022. That because of the economic downturn, because of some of the issues with COVID-19, that our total miles driven are going to remain relatively low, and therefore ethanol demand is going to be weak as we move forward in time. So don't count on the ethanol industry to suddenly have a big rebound and boom and be able to suck up all this extra corn we're going to be producing this year. I do want to talk a little bit more about exports. So this is a table that shows exports, total exports. It's in million metric ton, but total exports by year to by country. And notice that our #1 export destination for corn is Mexico. And that's going to have, and please remember that #1 corn destination is Mexico. Mexico has had some real issues with COVID. Their economy has had a very substantial retracement. They're in, just like in the US, we've had 2 consecutive quarters. They're in a recession right now. The economic recession is hitting Mexico pretty hard. And that is one of the things longer term I'm a bit concerned about on our export pace, is what's happening economically to these major countries that we're trying to sell to. Now the 2020, that current old crop marketing year we just finished, and the 2020-21 numbers, I have a little asterisk in the top right-hand corner. And the reason I have those asterisks is the 2019 numbers are not official closeouts yet. That was the highest number or the most recent number we had out of the export sales numbers, but there can be some small adjustments as we get to the final closeout. We don't have the official numbers out of USDA yet. But notice what's happened to export sales into Mexico. They were off a little bit in the 2019-2020 marketing year. So far, they have pre-purchased. So the 2020-21 numbers are the amount that they have already purchased for delivery in the next marketing year. So these are sales they've already made, or purchases they've already made for delivery into the 2020 marketing year, okay? So when we look at historically kind of how much pre-buying has Mexico and Japan done, these are very similar numbers. When I look back kind of at this time period historically, these are kind of typical levels. So they're looking at a kind of a normal pace of buying, at least early on in the season. I want you to kind of go down towards the bottom of that slide and look at China. China has been a very challenging market for us, especially since Mir 162. If you remember the Syngenta issues, prior to that, China was buying and starting to buy a lot of US corn. The record high purchases by China of US corn was 5.1 million metric ton. 5.1 million metric ton in 2012 of all years, okay? If you notice the far right-hand column, they've already pre-purchased for delivery in 2020 marketing year, 8.8 million metric ton. So when we look at what are the implications or what are the benefits and costs of the China trade war and this phase 1 agreement, this has actually been one of the winners. Because one of those chapters in that phase 1 agreement was talking about agriculture and removing some of the barriers to trade, for agricultural trade between the US and China. So even though we expected China to come in and buy a lot of US soybeans, and they're starting to do that, the real beneficiaries of some of this phase 1 agreement has been in other commodities. And some of that has been in the meats, in the meat arenas. But corn has been one of those beneficiaries. And I'll talk a little bit about what's driving these corn purchases actually in my next slide. So what's the driving force? A lot of it has to do with just the growing demand for livestock feed in China. And everybody points to pork, and yes, we have African swine fever, and they're doing a better job of controlling African swine fever. They are net rebuilding. So they're losing some hogs because of African swine fever, but they're also rebuilding. But there's a pretty substantial shift going on within their hog industry. The ones that are being cleaned out, or the ones that are having the biggest trouble with African swine fever, is kind of those, what we call the backyard producers. They're the smaller producers that have more of an open air system. When those guys have to clean out, when they have to slaughter their animals and clean out, a lot of those animals are being refilled into larger confinement hog operations. Because of the biosecurity that's available through the larger confinement hog operations, they can prevent or at least limit the exposure to African swine fever. So the net gain is still growing. But we also forget about the size of the poultry industry, and poultry being both the meat as well as the eggs. We forget about the dairy industry, and they also have a pretty large, vibrant aquaculture industry. All of those need feed and feed products. Okay, so when I start looking at what's driving behind this, a lot of it is the demand base coming from the Chinese market. We're also looking at as a signal. So I'm using what are they actually doing versus what's the rhetoric in the marketplace. What are they actually doing? There's actually pretty strong crush margins right now for soybean crushing in China. That has been going on for a while. Even though soybean prices are going up, those crush margins, when you look at the feed and the oil, the meal and the oil value, are still pretty strong, which signals to me that there is this strong demand for feed. Chinese corn production. Now realize and please remember, China is the second largest corn producer in the world. The United States is largest. We produce more corn than anybody else globally. China's number 2. And they're still a little ways behind us, but they're growing, just like we're expanding in our total production. The other thing that China did recently was they put an 80.5% tariff on imported feed barley from Australia. So now that's only about 2.5 million metric ton, which doesn't sound like a lot, but on the margin, that can make a difference. So that has to be replaced by something. They are going into the global market and trying to get more feed barley, but there's very few places that have additional exportable stocks of feed barley. So some of that is going to have to be replaced by corn or potentially feed wheat. The other thing is that the government, the Chinese government is having, they usually have these regular auctions. So they have government-owned stocks, just like our old CCC grain reserve days. When you take some of the older product, you rotate that out and bring in some newer stuff so that it doesn't deteriorate. Those auctions, those sale prices, they're starting to bring their net inventories down. The sales are being more aggressive than the purchases. And the sales prices, because they have a kind of a reserve price, a minimum price in these auctions, those auctions have been actively traded, which again signals to me that there's a pretty strong domestic demand for the corn that's being offered into the marketplace. There is some concern about, again, the trade tensions between the United States and China. I'll talk about that in more detail in a moment. But even on the Chinese side, some of the Chinese buyers, both government-owned companies as well as the private companies, are building additional inventories because there's a concern about what's going to happen politically. Because even companies in China were caught off guard when the tariff war started. And so some of those buyers got caught short. They were anticipating buying more corn, more soybeans from the United States. All of a sudden, the tariffs went on, trade barriers came up, and they were caught short. They were short of supplies. So to prevent that, as a risk management tool, as a risk management technique, they are starting to build some of their inventories. And I will argue, and others may argue differently, but I'm going to argue that yes, the presidential election is being watched very closely. But what's driving this building of stocks and reserves is not the presidential election, okay? I also want to talk about the phase 1 agreement. A lot of people, when that came out and we saw those targets, again, Howard showed a graphic of what the targets were for purchases. But there's several clauses in that phase 1 agreement. And I apologize for the mistyping. I'll correct it when I send the final version out. But there's actually a clause in phase 1 agreement, and I tried to replicate it. It said parties acknowledge that purchases will be made at market prices based on commercial conditions, and market conditions, particularly in the case of agricultural goods, may dictate the timing of purchases within any given year. Okay. Now, and I'll talk about soybeans in a moment, but when it comes to corn, because that's what we're talking about right now, corn, it looks as though they have a pretty large appetite, potential appetite for corn. And a lot of that will be U.S. corn, but we also have to be concerned that we do have competition in the global market. We are not the only export destination for corn, or the major exporter for corn. Now these numbers, this again was in one of the Secretary of Ag briefing papers that came out as part of the WASI report. Again, if you're interested, I can share that with you or share the link to it. This is the Brazilian corn production. And Brazil has 2 crops. They got a first crop and a second crop. The second crop called the Safrinha crop. It's often referred to that. And again, approximately, give or take, about 75% of the production is in that Safrinha crop, the second crop. If you look at the very bottom of this graphic, when is the second crop corn harvested? That would be the goal, that orangish colored bar. When is that harvested? June, July, August, September. Right now, they're just kind of wrapping up their corn harvest, at least their safrinha crop corn harvest. That was a pretty good corn harvest. They have exportable stocks. We're not the only place China can go for corn in the global market. I did pull some information. One of the things we have in our commodity trading lab that we have at NDSU now is additional sources of information. So I went at the close of business, is actually as of yesterday, I pulled the forward bids. These are the bids from kind of composite bids from companies for delivery of corn at different times into the future. So if you're an international buyer, this is the information you're getting about when should I buy corn and at what price if I wanted to buy it from you. Now, this doesn't include transportation costs. I've got some information if you're interested in ocean freight costs because there's some differentials. But if you notice, the green line on top is US PNW. Okay, and again, this was FOB bid. So this would be the bid for corn loaded onto a vessel. So all you have to do is pay the additional transportation costs to get it there. Now, freight costs into North Asia, which would be like China or Japan, they're much lower for PNW than they are out of the Gulf or out of Brazil. But let's just look at the price trends. This is what I'm going after, is the price trends. If you look at the US Gulf, it is right now the lowest price loaded onto a vessel. And actually out of the US Gulf today, there's a freight advantage shipping out of the out of the US Gulf versus shipping out of Brazil. So right now there's a very strong signal. If you are buying corn and you're a Japanese buyer or a Chinese buyer, the cheapest source for corn moving into the future months, and this extends through the spring, looks to be the US. Okay, so I do think even though we have competition, and obviously as a buyer, I'm going to play, country A against country B or company A versus company B, it still looks like right now, based on everything we know, we have an advantage shipping into both Japan as well as into China. And that's a good thing. Now, obviously these numbers can change at any time because these are bids for delivery into the future. What do we think is going to happen to price movement? This is at the end of the day kind of the kicker. This is the problem that we have. We've got adequate supplies of corn. Even if we start taking some top end off of the yield, and even if China does come in and start buying more aggressively out of the Gulf or the PNW, probably the Gulf because of the differential in shipping rates and some of the things that Brett talked about with basis levels. If you got to deliver it to China, where's the cheapest way to get it there? Okay, even if that happens, our stocks to use ratio, our carryover stocks are still going to be very, very, very adequate. Okay, so what the tendency is when we have large carryover stocks, prices tend to be relatively low and relatively stable, which makes marketing very difficult. So if you get some pops, you get some rallies, you get some sudden unexpected news into the corn market, my advice is you better jump on it. Okay, and I pulled this chart last night. So again, because of the timing of trying to put all this together, again, this is very simple support and resistance levels. We can argue a little bit about the exact places to draw the lines, but this is the lines that I've been drawing. Now, this is for December corn. This is for harvest delivery corn. We've had a nice little rebound. We had another increase today. That 475, I guess, in my opinion, is kind of that first major break point. Could we get through that? Possibly, but we're going to have some help. 405, in my opinion, 405, at least December futures, and you can look at the carry in the market and kind of add about 10 cents or so to each of the forward months. That price level seems to be a real trigger point. It's been very, very difficult for us to get back to those levels. And the reason I'm picking that number is because when you look at the profitability and the price ratios, the profitability levels for ethanol plants, that's when they start really having profitability problems. And as I saw before, ethanol is a major consumer of US corn. So as prices get higher than that, A, I think we're going to see some backing off of the international markets, but B, the ethanol plants are going to start to run into some financial issues and they might be backing off a bit on their production levels as well. Okay. Shifting to soybeans. Again, same, this is supply demand tables from the September WASDE. I just want to focus on the yield forecasts. Yes, USDA took a bit off the top end of the yield for soybeans. My personal opinion is I think as we get into the October numbers, as the combines start to run, we may see a little bit more of that taken off. But here's again kind of the kicker. Here's the fly in the ointment. We're above trend line yields. When we look at yield expectations today relative to what would be an average crop, we're still looking at a very strong yield forecast. So yes, we can probably take some off that yield. It will definitely tighten up our bottom line. But we're still looking at good production. Okay, so again, this is the same graphic. Now they've added North Dakota, and I know probably on your computer screen this may not be as sharp and resilient as you like, but you can download it in the PowerPoint later on and see the numbers. Again, the darker the green, the higher the yield potential. That really dark green is about a 60 bushel soybean crop. When we look at usage, so let's shift gears into the usage side of the equation. One of the bright spots, even through some of the China trade war, has been our crushing demand. And crush demand remains very strong. It did back off a little bit. We got a NOPA numbers, the National Oilseed Processors Association numbers for I believe it was for August. Their production numbers were backed off a little bit, but they're still at very, very high levels historically. And a lot of that has to do with our export demand, not only demand domestically from the meat sector, but also the export demand for meal. We look at the red line, which is exports. I mean, fortunately, we have this phase 1 agreement. China is coming in and buying. I think USDA's their forecasting models have recognized some of that. Could they be higher than what USDA is forecasting? Possibly. Again, it all depends. And I've got a couple charts here I want to show you in just a moment to reemphasize that. So let's talk specifically about China. Again, this is the same graphic on how much historically has China, as well as the other countries, bought from the US. Where do we send all of our soybeans? Now, the challenge we had during the trade war was we said, well, if you don't sell soybeans to China, we'll just sell them to somebody else. Well, the challenge with that thought process is if you're going to sell whole soy into the global market, you have to sell it to someone with a crushing industry. Because the end use, corn, you can offload it onto a vessel, load it onto a truck, and it could be an animal's stomach a few days later. Soybeans, you've got to crush it. It's the meal that's of the value. That's where the value is generated, and as well as the oil. So if you're going to sell US soybeans into the global market, you got to find a country that has a crushing industry that has the capacity to utilize it. And the problem is when you take China off the table, there's very few countries that can backfill that. Okay. So, but let's look at the numbers. All right. So the peak exports, our peak exports of soybeans into China was that 2016-17 marketing year. That was basically just before this trade war started. The tariffs went on in 2018, which is part of the marketing year. So we took the top end off of that number. And obviously 18 and 19 have been full-blown trade war. On 2020, let's talk about 20. Again, the numbers in that 2019 column are not official closeout numbers, but they're going to be very close. Let's look at that 2020 number. This is the amount of soybean that China has already purchased for delivery in the 2020 marketing year. Now, when I look back, when I take out those trade war years and I look back historically, I say, well, how much of China's total buying came in those pre-harvest purchases? And it varies quite a bit from year to year, but a lot of times it's about 50%, give or take. Sometimes it's a little bit less than that. So if we just use that 50% number for simple math, you take that 15 million metric ton and you double it, we're looking at about 30, maybe 31 million metric ton based on their, if they follow the historical buying habits. So even though today's purchases are much more aggressive than we have seen for a couple of years, if we go back before the trade war, their purchasing habits right now, the volumes they're purchasing as well as the timing of purchases have fallen back into something similar to the process we saw before the trade war. And for me, that's very encouraging, to be very honest with you, because one of my big concerns was once we do get trade reopened with China, are they going to continue or go back into their buying habits, or has something fundamentally changed? The early indications, the early signals are it looks as though they're falling back into their traditional buying habits. I'm crossing my fingers that that continues. Here's the other thing, and this one I want you guys to, if there's one slide I want you to remember from this whole presentation, this is it. Again, this is the forward bids. These are the FOB bids for global, for world soybean. So as we look into, if you're a buyer of U.S. soybeans or of global soybeans, this is the current bid structure in the global market. The red line is Paranagua, Brazil. That's one of the major export facilities in Brazil. They've got two major ports, Santos and Paranagua. A lot of the volumes of soybeans go through either one of those ports. So the red line is the bid. If I wanted to buy from Brazil in, let's say, December, the current bid for December purchases would be about $435 a ton. The blue line is the U.S. Gulf. And now PNW doesn't go out, at least the data that I have, the forward bids don't go quite as far. But look what happens in January. Look what happens, and this is the current bid structure. This is what we have today. The market is already signaling by the time we get into January, February, all of a sudden Brazil and Argentine beans may actually be much more competitive in the global market than U.S. beans. So we have to be very careful. And you look back historically, you guys that have been listening to me from before, I always show that graphic of what's the historical soybean buying habits or our export pace, whether it be China or just global deliveries. And we have very, very heavy sales from U.S. harvest through about that January, February time period. By the time we get into March, our export sales are dropping off very, very quickly because what's happening? The Brazilian crop is coming on board. And right now, the Brazilian crop, the forecast is for about a 6% increase in production from the previous year, about a 3% expansion of acreage. So if Brazil has a normal year, normal production year, you know, again, they're going to have a big, big crop. When we look at the futures prices, and again, today we had another update. It was up, actually closed, this chart, they closed at 10:11. When I pulled this about, again, this was at the close yesterday, we were about 9.90. So we had the close of about 20 cents higher. Question is, and I get this just like Brett, I get this, when's it going to top out? How, you know, when is this going to happen? And my only answer is, when you look at the technical analysis, when you look at kind of just the fundamentals, this looks like it's getting really top heavy. And one of the things that I'm very, very worried about is when you look at the amount of managed money that's currently in the marketplace, they're very long soybeans. So long means you buy low, sell high. And what they're waiting for is this market to tip over. And once it looks like it's tipped over and we're on the downward slide, those guys are going to start taking their profits. They're going to sell off their positions very, very quickly. Now, if you got old crop that hasn't been marketed, I don't know what you're waiting for. If you've got new crop that hasn't been priced, I would really, really be thinking about selling pretty hard right now. Not 100%, obviously. I wouldn't get overly ambitious at this point because there is still things that can happen. But if you have not made a lot of sales already, now is the time, because I'm very, very concerned that I would hate to risk a drop of about 50 cents a bushel to try and capture that last 10 cents. To hit that high of the market is impossible, and it's just too high risk. So I want you guys, if you haven't been selling into this rally, I'm just wondering what you're waiting for, and we'll just leave it at that. Now, one of the things, this is carryover stocks, and what I've been saying for quite a few years is for soybeans to rally, for the soybean market to get kind of uncomfortable about carryover stocks, we need to get to about a 10% carryover. If the 10%, if the stocks to use ratio is larger than 10%, the soybean market's comfortable. It'll be like the corn market. We have adequate reserves. We're going to have relatively low levels. We're not going to have much price volatility. But when we get to 10%, that seems to be kind of the psychological tipping point. As we get lower than 10%, the markets get to be very sensitive. They get to be a little more jumpy and nervous. And so we tend to have a little bit higher prices, but they tend to be a lot more volatile. And we're pretty much right at that 10% right now, given USDA forecasts. So if we start tweaking the numbers a little bit on exports, a little increase in exports based on, the current USDA numbers versus, and take off a little bit on the yield side, we can get into this zone where we have a lot more price volatility. Finishing up with wheat, and again, I got a lot more to go through, but we'll cut it short here. Wheat yields, we're going to have an okay year, not a fantastic yield year. When we look at usage, we've slipped into this comfort zone, right? Now, I do want to point again, the blue line is domestic use, it's domestic milling. The red line that bounces around is the exports. Obviously, we can have some shocks and unexpected things in the export market. That's really what I want to focus on right now. So we look at who buys our U.S. wheat. I've got the same graphic in just a second on on spring wheat only. Number one customer is Mexico, and then the Philippines, and then Japan. So those are our three big customers for U.S. wheat. Now this is all wheat. Okay, the 2019 numbers are official. We've closed because June 1 is the end of the marketing year for wheat. When we look at pre-purchases, the amount that's bought already, our traditional customers are kind of right on pace. Their buying habits are very normal. Let me drop down to the bottom line. Let's talk about the big gorilla in the room. Let's talk about China. If we go back to 2016, they bought a lot of wheat from us. And most of that was spring wheat. If you look at pre-purchases, the far right-hand column, what they've already bought for the delivery in 2020 marketing season, they've already purchased and booked more than they did last year. And the question, I know this is the question floating around in the wheat market, all right, what's the Chinese appetite for wheat? So far, most of the buys have been hard red winter wheat because that's been the value buy. And understand, China is a value buyer. It's that you don't have to be the lowest price, but you got to be the best value. And I don't expect China to really come in and buy U.S. spring wheat until later on in the season. We got to get through corn harvest to be able to clean out some of that corn for basis levels to improve, for farmers to be able to sell, and for that P&W basis to try and improve to a point where we're competitive. Again, we look at, this is hard red spring wheat. Who's the number one customer? By far, the Philippines. So let's come back to COVID. What's happened? What's the impact of COVID on the Philippines and the Philippines economy? What's the impact of COVID on Japan and Japan's economy? If we go back, let me go back up one. Number one country for wheat exports, Mexico. What's COVID done to the Mexican economy? These are things in the back of my mind. Even though there's a lot of optimism, there's some potential here. There's still some clouds on the horizon that I'm kind of concerned about. And I know I'm bumping up to my time limit here, which is normal for me anyway, right? So here's the price target levels, and again, these are included in the PowerPoint slides. Wheat carryover stocks, we're comfortable. We're not short of wheat. And then what did I say before? Big carryover stocks where we got these reserves in place. Prices tend to be relatively stable. They tend to be relatively low. When we look specifically at spring wheat, we got plenty of spring wheat, guys. And the Canadians are going to have a pretty decent crop again. So I don't think globally the world is short on spring wheat either. So let's talk about China trade policy. I get a couple questions on politics. I'm not a politician. I'm not a political science major. I'm not going to try and project who's going to be in the White House. Howard already covered a lot of that. I do want to talk about this China trade, though, in the presidential election, because this is coming up in a lot of conversations that I'm having. So there was an interview that BBC News did of a bunch of Chinese buyers. And these are global ag buyers. And this is a direct quote from their article. One thing is clear, though. Companies in the mainland, meaning China, believe that whoever is in the White House, a tough stance on China is here to stay. Let me get another quote. This is from a Fortune magazine quote. And this is more on the US side of the line, but they tried to get a perspective from the ag community and said, again, I'm just going to highlight, one policy position appears set to remain the same, regardless of who's in the White House. A tougher, more adversarial stance toward China, especially on issues like trade and national security. So just because we have a phase 1 agreement doesn't mean this is over. Both President Trump and Vice President Biden are taking a very similar view on how we need to interact with China. Their strategies and how to do that are slightly different, but they're both taking a very tough stance on China. So this business of the trade tensions and the political tensions between the two countries are going to remain. And that is a risk, and a risk in the marketplace we have to be concerned about. So be watching the news very, very closely. I got one slide on COVID. Most of this stuff on COVID-19, this talks about demand and how people are adjusting their buying habits. And I am concerned, as I said before, internationally about the economic downturn, and more importantly, what's happening economically internationally, and what are international buyers going to change. So far, it doesn't seem that they're changing their buying habits on what they're buying and how much, but we really have to monitor that very close. The only thing going into harvest, I'm going to jump ahead to this one. One of the things is I talk to CEOs or general managers of companies in agriculture, whether they processors like an ethanol plant or a wheat mill, whether they be in a local elevator. There's a lot of concern internally in companies. What happens if we have key people in our industry, in our firm get sick? So even though we're not going to have, in my opinion, broad, widespread shutdowns like they had in the meat packing industry, individual firms can have problems. And in particular, as we come into harvest, what happens if you have an outbreak in your ethanol plant? What happens if you have an outbreak in a sugar beet plant? Right? What happens if just a few key people get sick? You don't have to have a total shutdown of the whole plant. What happens if some really key people in your organization get sick and have to be out for a while? Either quarantined or get sick and stay at home. There can be local supply disruptions. And I point that out just to get people thinking that as we move into this peak harvest season, please be careful, be safe. We want everybody to have a nice, enjoyable winter. Okay, so with that, I'll stop because I'm already 5 minutes over the time, which is normal for me anyway. So you had a couple questions, it looks like.
Going for it here, Frayne. So is 2019 spring wheat quality affecting this coming export year's demand for U.S. wheat?
So is 2019 wheat quality impacting the 2020 export pace for wheat? In my opinion, no. Okay. Now we did have, as Brett showed, and I know Betsy also showed about with the falling numbers issues, getting rid of falling numbers is a challenge. If you've got low falling number wheat, man, that's tough for a wheat mill to do anything with. If you have low protein wheat, we do have outlets, export outlets primarily, for low protein spring wheat. Again, you're going to take a discount because you got extra transportation costs, and a lot of those buyers are not used to dealing with a spring wheat. They're more used to dealing with a winter wheat. So we can get rid of low protein. We do have a problem with falling numbers. And a lot of the low falling numbers has to go into a feed product anyway. But the 2020 crop is much better quality. We've got average to slightly above average proteins, depending upon where you are in the region. Yields have been, in general, pretty favorable, not necessarily a banner year, but they're not horrible. Protein levels have been, as I said, pretty much normal. I haven't heard of any major falling numbers problems. There's a few places that have had some scab problems or fusarium problems, but again, the DON levels are relatively low. So it looks like the quality of our 2020 crop is going to be favorable. The stuff that's 2019 that's still very poor quality, we're going to have to force that through alternative channels anyway. Okay, anything else? All right, thank you very much, guys. I appreciate your time and attention.